Hi there, my name is Levi G, and this is my term project for Buad 111. Today I'm going to be taking an in-depth glance at Chapter 5, which focuses on the differences between merchandisers and service-based companies and the intricacies of the accounting process. First, let's talk about what differentiates a service-based company from a merchandise-based company. Service-based companies simply need to deduct operating expenses from its service revenue to calculate the profit or loss because they offer a service rather than a product. Whereas the nature of a retail company, there's a few extra steps to calculate the profit or loss. One of the main differences between the two types of companies is that merchandising companies must first acquire stock from a wholesaler, which is then marked up accordingly and sold to the customer. Because of this additional step, a merchandising company must take the time to document their merchandise transactions. These transactions are then used to calculate the cost of goods sold, which, when subtracted from our sales revenue, equates to our gross profit. Subtracting operating expenses from gross profit then gives us a profit or loss for the time period. Companies are faced with a plague of decisions to make when starting a company, and each and every one of those decisions can shape the general direction of the new business. One of these so-called decisions is which inventory system to select. There's two basic kinds of inventory system used, a perpetual inventory system or a periodic inventory system. The perpetual is better at keeping a current and up-to-date stock of the inventory after each individual purchase or transactions, which means that a properly organized store can keep up-to-date numbers on each and every one of its items at any given time. This can be useful when answering consumer questions based around stock or inventory, or even when facing inventory shortages or discrepancies. However, the inventory system can be costly due to software and technology that is required to keep the system. The next type of inventory system is known as a periodic inventory system. This system leaves behind complex computers and goes for a much more simple hands-on approach. Instead of keeping a perpetual stock of every item, the business opts to calculate its cost of goods and inventory stock at specific periods instead. This entails determining the cost of the company's initial inventory, the cost of those goods, and then to get the total cost of goods available for sale. By taking the initial cost of goods available for sale and subtracting the cost of the ending inventory, the cost of goods sold is then calculated within a perpetual inventory system. Looking more in depth into the perpetual inventory system, it's quite common to break up our inventory, accounts receivable, and accounts payable into a separate grouping of accounts known as a subsidiary ledger. This is done to break up what would be otherwise a very confusing and long series of accounts into an organized and likely grouped expansion of the general ledger. The next topic I'm going to be covering is the documentation of acquiring new merchandise or inventory. A business will buy new stock either by using good old-fashioned cash or on account, which is otherwise known as credit. These purchases require proper documentation to ensure efficient operation of the business. For example, all purchases using cash must have their corresponding cash receipts. These cash receipts will increase our merchandise inventory and decrease, of course, our cash account. This is a contrast against any purchases made on credit, which are documented via sales invoices from the seller. This credit-based purchase will increase both our merchandise inventory as well as increasing our credit account, accounts payable. But what would all this organization and work be for if the merchandise or service-based company couldn't even receive its goods? So let's next talk about shipping and freight costs and how those work. So whoever owns the goods being shipped during the time of the transportation is responsible for both safe delivery of said goods and to incur any costs related to its shipping. So the point of when ownership transfers from seller to buyer is known as the free onboard destination or shipping point. Free onboard shipping point means that the purchaser is responsible for the shipping costs and to incur any damages related during the shipping process, whereas free onboard destination means the seller of the product pays both shipping costs and is on the line for any damages during the shipping process. But what if a business receives inferior or otherwise unsatisfactory products from its supplier? This concept is known as a purchaser return and allowances. When a product is of inferior quality, has present defects, or is in any way not to the buyer's standard, a purchasing return or allowance is given. This is either rectified with a full refund for the defective product, or a discount is given in place of the full price of the product. This discount is known as a purchase allowance. A purchase would positively affect our accounts payable by the amount of the return while subsequently decreasing our merchandise inventory on hand by the same amount. While purchase discounts are a common form of discounts given to businesses, they are not the only form of discount seen. Another common form of discounts are called quality discounts. This discount is given to a business under specific terms, typically related to quantity purchased or a time frame in which payment is made. For example, a business may be offered a discount if buying X amount of product or for paying for said product within X amount of time. But all of this information, product, and revenue would be wasted, however, if not for being properly recorded. This is where two different methods we use to recognize revenue come into play. These methods are known as the contract-based approach, which is adopted by companies conforming to the IFRS structure, and the earnings-based approach, which is followed by proprietorships following the ASPE format. Looking into the principles behind the earnings approach, we can see a highlight on the importance of keeping receipts of sales transactions. These transactions are to be recorded using transactional receipts or invoices which are given to them from receiving goods from a seller. Using these recorded transactions, we can begin to make two separate entries, assuming we are using the perpetual inventory system. We first record the sales revenue in the form of cash or credit, which increases our debit value, and it also increases our credit account sales. Secondly, we record the cost of merchandise sold, which is an increase in our debit account. And then we can decrease our asset account merchandise inventory by a credit for the cost of the goods sold. Now that we've gone over a brief overlook of some of the rudimentary entries and concepts merchandising and service-based companies face in their day-to-day operations, let's now look at how all of these fit into our financial statements. Well, adjusting entries may be required to adjust mistakes from both service and merchandising companies alike. Merchandisers who use a perpetual inventory system may need an additional entry. If actual inventory for a company does not match the inventory on hand, an adjustment to the cost of goods sold and merchandise inventory must be made. Once the adjustment has been made in order to properly close open accounts, all accounts related to profit are zeroed out or to be closed out to the income summary account. At this point in the accounting cycle, we either use a single step or multi-step income statement, and that is used to show our revenues, cost of goods sold, delivery expenses, and then calculate our profit or loss for the given time. The single step approach to income statements is favored in a company that does not realize profit until revenues surpass total expenses, or one that prioritizes the simplicity and ease of reading a single step income statement. The multi-step income statement, of course, is a more complex and in-depth look at a company's financial records. While additional steps are required to produce one, it makes other key statistics such as profitability more readily available. The multi-step statement first calculates net sales before deducting the cost of goods sold to obtain our gross profit. From there, the gross profit has operating expenses deducted to ascertain profit from operations, which is then further reduced by removing non-operational revenues, finally giving us a profit or loss for the year or given time period. But what do all these numbers really mean? Well, they give us the figures we need to calculate different ratios which calculate and correspond directly to how successful our business is. These ratios give insight for management on how to improve business operations, as well as they provide a looking glass for outside creditors and investors into the day-to-day operations of the business. Introduced in this chapter are profitability ratios such as the gross profit margin. The gross profit margin is speculated to be more useful than gross profit. This is because it factors in net sales, which are then divided against the gross profit, showing the inverse relationship between the two values instead of only looking at the gross profit. Next and finally, we have the formula to calculate our profit margin. Profitability is measured as a percentile of sales within a given period. This is similar to gross profit, but instead shows a relationship of each amount of sales that provide that profit. Profit margin is calculated by by dividing profit by net sales to calculate a percentage.